didn't know much about Pinterest at the time. I had not been a user of the app. I mean, I had heard about it, but the big sort of light bulb moment for me was when I asked my wife. I said, "Do you know about this Pinterest app? Like, what do you think? I'm thinking about maybe putting in some money." And she said, "Well, yeah, every bride in the world uses it to plan their wedding day." And for me, that was like the big aha moment. It's like, well, wait a second, that's a very large and lucrative and global market. So maybe there is something here. So I ended up participating in that syndicate, and then that same group, a few months later, ended up doing a syndicate into Lyft. And for me, going back to my Coca-Cola days, my thinking was, well, there's room for two people in every market, right? You got Pepsi and Coke, where Uber was already taking the world by storm. I'm like, well, there's probably room for this small Lyft guy as well to gain some market share. Obviously, they never became as big as Uber, but both companies, Pinterest and Lyft, went on to IPO in 2019, and then that really gave me the seed capital to start Allied. I think Drew and Arash from Dropbox, they're a really interesting case, because if you look at what they built, like at the time, everyone passed on them. They said Google and Microsoft, everyone is just absolutely going to smoke you guys. Like, there's no way you can compete. But they had a really clear vision. They understood where the market was going, and now they've built a multi-billion-dollar global company.
Today's guest was an early angel investor into both Pinterest, Lyft, and 100 others. He's a LP in Jason Calacanis' launched Angel Syndicate. He's also been an exited founder. He built and exited a consumer packaged goods startup. But he's also been a salesman and marketer for Coca-Cola, Nestle, and many other big, massive companies. He's generated millions of dollars in sales. So without further ado, I introduce Matt Wilson. Matt, welcome to the Builders and Funders Show.
Oh, Burke, thank you for having me.
Absolutely. I wanted to start by going to sort of the beginning, the inception of your career. You start kind of entrepreneurial endeavors all the way back at like 11 years old. You're learning coding at 14. You're building these small businesses, doing these small hustles. You were a lot like me and many other entrepreneurs when they were young, right? But then you choose to take a different path. Instead of going straight into building in college or building throughout college, do you decide to go into sales and marketing? You work at Coca-Cola, you work at Nestle. Why did you make that decision? Why did you choose to have a job? And maybe how did that help you as an entrepreneur and angel investor later down the line?
Yeah, for me, like that transition really occurred because in my teens, I had an opportunity to pursue a career as a professional ice hockey referee. So when you're young and you've kind of got that, you're young, you're good at sports, you've got the capabilities to do that kind of stuff. So I really had to pursue that. So I ended up moving to Toronto because I'm originally from Ottawa. So I moved to Toronto and I pursued that career for a number of years. And basically, because all the hockey games happen on evenings and weekends, I ended up taking day jobs at Nestle and Coke to fill up my time and make some additional money. So got to join some large companies, see the inside of like how large enterprises work on several enterprise sales teams, help build out different divisions, and ultimately grow my own personal books. So that's pretty much the reason why I didn't jump into my own business right off the start out of school, because I was pursuing that athletic endeavor.
Absolutely. When you study a lot of the great investors of the past and even the present, something you see a lot is their temperament. They're very calm, they're very collected, they're very analytical. Anyone who's worked in finance tells you, the best ones are the ones who are unemotional, sometimes a little autistic even, perhaps. And so you mentioned you go into being a referee before recording. You talked about how that kind of helped you build your temperament and how that helped you become an excellent angel investor. Talk to me about that. Tell me about some of the lessons you learned, and also if how someone listening to this could replicate some of the traits you developed being a referee.
Yeah, it's a really unique set of scenarios because like when you're officiating, right, you're basically trained to remove all emotion from your decision making process, right? So think about it. You're standing in the middle of an arena. You've got 10,000 screaming fans. You've got superstars on the benches. You've got coaches that are yelling at you, and you have to make the right decision in a split instant. And you have to do it without emotion, right? You have to get the decision right. And no matter what happens, 50% of the people are going to hate you, and 50% of the people are going to love you, right? Just that's just the dynamics of it. So they train you to remove emotion from the decision making process and look at things really logically and analytically. And for me, I've actually been able to take that and translate that into my investing career, because now, like, I see it as a temperament advantage, right? Like, if we go back to 2021, for example, when we saw the crypto craze, the NFT craze, people were spending hundreds of thousands of dollars on Bored Apes. Like, none of that stuff even phased me. Like, you could just look at it. I knew it was a phase; it was going to come and go, and I wanted to stay focused on my core underlying long-term investing strategies. So I was actually just looking up the chart earlier today, and I noticed that the Bored Apes are down, I think, 95% since that time. But like, it's so easy to get distracted and emotionally caught up in these different trends and these different waves of technology, and especially when there's money on the line, right? Like, people will throw money into something they don't understand on a whim because they see other people doing it. They get caught up in the emotion of the moment, and then they wonder why they lose money. So for me, I've really been able to take my athletic career learnings and translate that into a temperament advantage when it comes to investing.
So you mentioned they kind of train you to be able to stay calm in those situations. Referees are, coaches are yelling at you, fans are booing you. People are going crazy. So what are some tips that you were taught at the time? Like you're in the moment. With some people say like go to your happy place, like go into your mind, kind of retreat and go into your happy place and calm yourself that way. Some talk about breathing exercises. What specific kind of tactical things were you doing as a referee to calm yourself down and not let all the pressure get to you?
Yeah, I think it takes a certain type of person, just character, to not get phased. But then also, like, they teach you to lean on your teammates. Like, you're out there with the crew. There's four of you out there. So if there's a big decision that needs to be made on the ice, you come together. You talk about it. Okay, who saw what? We need to make sure we get the call right. Maybe you have the luxury now of calling upstairs and looking at the video review, but just understanding that you don't want to make a split-second decision based on emotion. If you just called three penalties in a row on Team A, and then Team A goes out and does another penalty, a lot of people might turn a blind eye and not want to call that because it makes them look like the bad guy, right? We're just calling penalties one-sided. But if they keep making infractions, you have to keep calling those penalties. And it's that type of stuff where I think the more reps you get and the longer you do it, you just get better at blocking out all that noise and then just focusing on the signal. And for me, I did it for 15 years. So by the end of it, maybe I was just tired of getting yelled at and heckled by fans, but I felt like I had built up that muscle pretty well in order to block out a lot of the noise and the emotional factors that come into the decision framework.
So it's kind of like two things, right? One is you mentioned perspective. So have the perspective that you have a team, you have people that you can rely on that can back up your call and they can go out there and analyze it. And then second is kind of persevere through the valley of despair almost and just keep getting your reps. And at some point that you get used to it. Are those kind of like the two big takeaways?
Pretty much, yeah. I mean, once you've been, called a certain name 2,000 times, like, it kind of just rolls off your back. It doesn't phase you anymore. So there's that element for sure. It just takes experience and reps. But like, also, like, coming back to leaning on your team, and like, if you look at a venture fund, for example, you've got a core group of partners that come together. They look at investments, they look at opportunities, and they have to make decisions together. So it's very similar in that regard. Like, you have the crew of people coming together to make the decision, go through the evidence. Okay, what happened? Who did what? And what's the subsequent call? So a lot of similarities, actually, surprisingly.
Interesting. So around the same time, you're at Nestle, and I believe, if I'm not mistaken, you're doing about almost $3 to $5 million in weekly sales with daily cold calls, lead generation, etc. While you were at Nestle, I met so many founders who they go and they retreat to their basement, they build, and they just can't sell, they can't articulate themselves, they can't sell their product, and so that's why they just remain at like 200 mrr and that's it. And so I want to talk about a few of the essential, like, less key sales lessons or principles you learned during that time. I think that's kind of like where your foundation began as a great founder, as a great salesman. So tell me about that period of your time and what you learned, and maybe even the first few like deals you closed. Like, I'd love some stories as well.
So I worked I worked in the ice cream division. So Nestle ice cream. So think drumsticks, parlor ice cream, all the different flavors. And we sold predominantly to major retail. So large grocery stores, gas stations, convenience stores, that type of stuff. So for me, I actually gained a little bit of weight during my time at Nestle because they had a free ice cream freezer on the floor, and my desk happened to be next to it. But I digress. But back to some of the lessons that I learned in terms of the enterprise sales was not trying to go in for the direct kill, like talking to the customer, really trying to understand what their problem is, so what their business is. So for me, like selling ice cream in the wintertime to gas station owners in Northern Ontario, for example, who are buried under 20 inches of snow, they're probably not going to want to order more ice cream if their freezer's already chock full because they haven't sold anything for a couple of weeks now. So for me, it was just about understanding their business, like what key drivers are there, what SKUs do they sell the most, what types of flavors do people like, and then helping them scale up for the summer months. Like I had quite a few people that ran summer ice cream stands, for example, at lakes and cottages, and they would spend their winters down in Florida or somewhere warm, and then come back to Canada in the summertime and sell ice cream and absolutely crush it. And that was their business, right? They do over $1 million a year in ice cream, if not more. So yeah, it just comes down to understanding your customer. You can never talk to your customers enough, I think, just to understand their business, as opposed to just going right in and assuming they have a set list of problems and then you're going to be the white knight with all the solutions. So people just want to be heard, they want to be understood, and I think when you're talking to customers, let them do like 90% of the talking, and it's really interesting the types of stuff that you'll learn and discover just by talking to more customers. And to your point earlier, I think it's great to build a company and be in your basement and just have everything happen online and not actually have to get out there and talk to customers. But at the end of the day, there's very few businesses that can succeed like that. You just have to talk to as many people as possible.
Around that time, you discover this opportunity and you decide to build a local organic coffee brand, if I'm not mistaken, right? And you build it and you exit in 24 months. Why'd you decide to build that? Where did that kind of idea come from? What kind of opportunities did you spot that made you go, this market is hot right now, we need to enter?
Yeah, my former partner and I, we both came from the CPG world. So I was at Nestle and Coke, and he was at Nestle. So we had a unique insight into the market in terms of what were some of the best performing products and SKUs in terms of food products out there. Coffee's one of them. The margins are phenomenal, but also we were really big coffee buffs. Like we would order raw beans. We bought a roaster. We would test out different bean varietals and come up with new recipes on the weekends, and just got really into coffee and passionate about coffee until one day we said, maybe we could start our own little coffee brand here. And at the time in Toronto, it was before the whole fair trade organic movement really took off. And at the time, you just had Tim Hortons, Starbucks, Second Cup, and maybe a handful of small little mom and pop shops. So we identified a unique wedge into the market where we could now present and position ourselves as fair trade organic, sell locally, direct to consumer. And some of the interesting challenges we ran into was, first of all, we looked at going brick and mortar retail, but the existing large incumbents had everything tied up in red tape. Like you couldn't be within 500 meters of a Tim Hortons, you couldn't be within 200 meters of a Starbucks. So we ended up having to scrap the brick and mortar retail route, and then we looked at going to major retail, so grocery stores, things like that. And one of the largest grocery chains in Canada, which is called Loblaws, we looked at getting into those grocery stores, and they wanted a $250,000 listing fee to be on the bottom shelf in the middle of the aisle with no additional exposure or market caps or anything like that. So that basically was not feasible as a young startup, a young cash strapped startup. So what we identified as our unique wedge into the market was going wholesale. So we started selling to hotels, conference centers, bars, restaurants, diners, local bakery shops, things like that. And it actually worked out incredibly well because the people that we were selling to were also small business owners like us. They owned that singular location, or maybe they owned one or two more, but they weren't a giant chain and they weren't locked up in exclusivity deals with some of the larger incumbents. So we wedged ourselves into the market there, and we grew it for 24 months. And then we ended up getting acquired by one of those local bakery chains that was our customer. But that was the biggest takeaway and lesson there is, as passionate as we were about coffee and we wanted to bring this product to market, distribution is really what it comes down to. Like you have to find out a unique way to get your product into the hands of your end customers. And some of the large incumbents, whether it's in the physical world, CPG world, or tech world, they're gonna really try and protect and put moats up around those distribution channels. So you have to find a unique way to get your product to
A
customers.
lot of people kind of look at what you did. You go from zero to exit in 24 months, and it seems like it was a smooth sailing journey. But tell me about the stuff when, like, as they say, the shit hit the fan. Like, tell me about those kind of moments of valleys of despair.
Yeah, I mean, oh yeah, it's well, CPG especially. Just there's so many challenges with regards to because you're moving physical product, so you have to deal with things like shipping and delivery, and then if the product gets damaged during delivery, and then you get customers like, for example, we would have diners and we would deliver their giant coffee crate on Thursday or Friday before the weekend, but we would get calls on Saturday at like noon and say, hey guys, we're running out of coffee. We're super busy over here. Like we need more coffee ASAP. And when you're a small startup, like you live and die by your first few customers. So basically, you got to drop what you're doing, drive a box of coffee over to that restaurant, get them set up, and get them running because diner patrons they want their coffee on Saturday morning. And if we can't deliver and we don't keep them in stock, then they're going to go to one of the big larger players, right? So just things like that, like always being on your toes, trying to keep your customers happy, keeping up with production, keeping up with distribution. But we were also the first company that introduced, we did a D2C program. So we actually sold retail subscriptions, coffee subscriptions through our website. So people could go online and they could actually sign up for, 2 packs a month, 3 packs a month, whatever it was, and then get those delivered to their house. So that was a nice wedge as well into the consumer side of things. But 90% of our business was still wholesale through our various distribution partners, whether it was restaurants, diners, hotels, and event centers.
I was reading somewhere that you had at some point almost a 50% month on month growth rate. How did you, I mean, you mentioned some of the logistical problems. Like you're moving physical products. That's a tough thing to figure out. And you got to figure out the supply chain and everything. But how did you get such a high growth rate? What were you guys doing? What was work?
Yeah, it like again, like the fair trade organic movement, like no one hadn't taken hold yet. And when you walk into, a bakery or a restaurant, you can be like, hey, listen, instead of buying this large mass produced coffee that kind of tastes like water, in my opinion, like here's one that's been made locally just down the street. We have our facility here. We're paying local taxes. We'll support your business. We'll promote you. You promote us. And because we were going after those smaller mom and pop shops, those one off restaurants, boutique hotels, that type of thing, they love to support local business. And I mean, maybe I'm a bit biased, but I thought our coffee was phenomenal. Like we had a really great tasting coffee. People loved it. We had 3 different SKUs plus an espresso. We imported the raw beans from Colombia and other countries in South America. So we roasted them right there. So we had a fresher product, we had a tastier product, and it was a local product. So people just really wanted to support that. And at the time, like, you didn't walk into Starbucks or Tim Hortons and see anything that said fair trade, organic. It was all just give me a cup of coffee. I have no idea where it came from, but I just want to get my caffeine fix. So we're able to ride that early movement. And now when you walk around, like there's so many coffee shops and cafes and fair trade this and organic that and locally roasted. So we were just lucky as well to be one of the first companies to do it like that in that market.
Absolutely. So like, I'm seeing like a few lessons here. The one is the unique value proposition you develop. So you were early movers in this organic fair trade coffee space. So and they say you can't time the market, but you guys did a great job of timing the market. And to my understanding, a good part of that was observation, but also a great part of that was just luck. It seems like that's for a lot of great startups, and we'll get into like how someone could do that. Maybe not time to market, but at least try and get it right and find some big trend, some big wave to ride. Second is how kind of aggressive you were. You're talking to everyone you could, just pound the phone, going to these stores. But then third seems to be like your conviction. You had so much conviction that even the people that wouldn't want to support you want to support you just because of how much they liked it. And I think Ryan Serhant says that sales is a transfer of enthusiasm. So it seems like you guys had that built-in conviction enthusiasm. But I want to go back to actually before that, what do you think about those lessons? Do you think those are fair? What would you add?
Yeah, for sure. Because like going back to my story from earlier, like it just started as a couple coffee nerds geeking out on Saturday mornings and roasting beans, and we were just really passionate and loved our coffee. Right? We wanted to try beans from different areas, and all these beans that we were getting were already fair trade organic, and we just noticed like the taste and the flavor and the profile is just so much better. So like, why don't more people want to try this type of coffee? Like, why are you going and getting mass produced watered down, crappy coffee from some of these larger players? Like people don't understand. Like there's a really good product out here. You just gotta be aware of it. And like you said, I think our enthusiasm just eventually passed on to the customers, and then that movement took off, and people expected a better quality product from their coffee moving forward.
Interesting. So it's kind of like, in terms of timing the market, it's actually kind of like, I was listening to a Paul Graham, the lecture at Stanford, and he was talking about how a lot of the best innovators he's met, they develop these weird obsessions in these different fields, and they just like learn everything they can, and at some point they're like, well, I know everything about coffee, and like this stuff sucks. Why isn't there a better alternative? And then at some point they just decide, you know what, I'm going to build that better alternative. And that seems to be kind of the inception of many of those great brands. It seems like you guys did a bit of that as well. You guys were like obsessing over coffee. You're learning everything about the field. And at some point you're like, well, actually, like this kind of existing coffee kind of sucks. It's not like organic. It's all like mass produced BS. We should do this stuff. And so it seems like that's a big part of, almost, you're creating your own wave, and you're kind of creating your own trend almost for the market to follow.
100%, yeah. And for us, just going back to the hockey link, like when we would go to hockey games, we would stop at Tim Hortons and pick up coffees before the game, right? Everyone would have their pregame coffee, and it just tasted terrible. So then I would start bringing my own coffees from home from some of my local stuff that I was doing, and I brought it to some other guys, and they absolutely loved it. And then finally, we said, well, maybe we have a little business here. Maybe we could actually make this into a product. And I think the same story goes with, you see a lot of people that start breweries, for example. They just start as passionate home brewers, and they're making beer for their friends and their family. And then sure enough, they decide to open a brewery, and then people start coming to their brewery and enjoying their product, right? So it just, yeah, it starts with passion. And for us too, working at Nestle, because Nestle is one of the largest coffee suppliers for a lot of the large organizations. And we didn't like the coffee at Nestle. They had it in the office. We were drinking it every day, and I'm like, this is kind of crappy. Like, there's got to be a better way. So that's also part of how it all got started.
hmm Interesting. Out of curiosity, why decide to sell that? So you're 24 months in. You've been building this thing for 2 years. You've got solid traction. I mean, you could have built a $1 billion company. Why decide to sell it so early?
Yeah, there was a couple forces. So predominantly it was, and this is probably one that's not talked about too often, but founder dynamics. So my co-founder and I, he had met his now wife, and he was starting to settle down and have a family and do that stuff. And then I had also met my now wife around the same time, and she had received a job opportunity out west, and so I was gonna look at potentially moving out west, and then my other co-founder, he was settling down and starting a family, doing that thing. So neither one of us really had the capacity or the passion to go in full tilt on the business anymore. So when we had the opportunity come across our desk, we said, you know what, it's probably best to just wrap things up now, because ultimately, like, I see this too in our own portfolio, like founder dynamics. You start a company, you're super tight, you're working together day in and day out, and then eventually you kind of get founder drift, where one person becomes more passionate about the business than the other, or maybe one person has certain things going on in their personal life that they need to devote more time to, and they can't spend as much time on the business. And then that can eventually lead to either friction or some bad sentiment. So we just had a really lucky opportunity where the acquisition offer came along, and it just was the right timing. Like, I wanted to move out west, and he wanted to settle down, do the family thing, and yeah, that's just the decision that we came to.
Interesting. That's okay. That makes sense. And as you're starting to do this kind of scouting thing, and you kind of became obsessive, and you're going to events, and you're working with syndicates, and you're doing everything to learn about VC, the venture capital world. You're doing everything to learn about the mind of an investor. At the time, you're working, kind of apprenticing even for a few VCs. What did you learn during that period of how an investor's mind worked? And then what are maybe some stories you've got about that period?
I was really fortunate. Again, it comes back to luck and timing because I just happened to go to a venture capital conference one week and just trying to learn more about the industry. And I ended up meeting a group of people that were syndicating deals and syndicating investments into companies out of venture capital centers like Silicon Valley, New York, Boston, etc. And got to know these guys, kept in touch. And then a few weeks later, they reached out because they were syndicating an allocation into the Series B of Pinterest. And they asked me if I'd like to participate. So didn't know much about Pinterest at the time. I had not been a user of the app. I mean, I had heard about it, but the big sort of light bulb moment for me was when I asked my wife. I said, "Do you know about this Pinterest app? Like, what do you think? I'm thinking about maybe putting in some money." And she said, "Oh yeah, every bride in the world uses it to plan their wedding day." And for me, that was like the big aha moment because it's like, well, wait a second, that's a very large and lucrative and global market. So maybe there is something here. So I ended up participating in that syndicate, and then that same group a few months later ended up doing a syndicate into Lyft. And for me, going back to my Coca-Cola days, my thinking was, well, there's room for two people in every market, right? You got Pepsi and Coke. Their Uber was already taking the world by storm. I'm like, well, there's probably room for this small Lyft guy as well to gain some market share. And at the time, I don't know if you recall, but there was a boycott Uber movement going on, delete the Uber app. So Lyft was kind of emerging
After
as
the video of Travis Kalanick went viral of him yelling at that one Middle Eastern Uber driver, right? And that's kind of how things conspired.
exactly, yeah. It started with that, and then there was allegations of stuff going on, like poor culture and poor mistreatment of female employees, things like that at the head office. So Uber was under a lot of pressure, and Lyft was kind of emerging as like this good guy number two. And my thinking was, well, there's a room for a number two in every large market. So let's support Lyft and see where they can get to. And obviously, they never became as big as Uber, but both companies, Pinterest and Lyft, went on to IPO in 2019, and then that really gave me the seed capital to start Allied in 2020.
Absolutely. And I think you've made somewhere around 100 plus investments. I'm sure you've had to analyze 1,000 or more of them to actually get to that final 100 plus. If you were to the point you can recall since 2011, who would you say is like the most notable founder you've met? Someone who's really stood out to you, and why? Why did they stand out to you, and why did you maybe decide to invest in them?
I think Drew and Arash from Dropbox, they're a really interesting case because if you look at what they built, like at the time, everyone passed on them. They said Google and Microsoft, everyone is just absolutely going to smoke you guys. Like there's no way you can compete. But they had a really clear vision. They understood where the market was going. They identified a unique wedge into the market with design professionals who needed to upload their work, put it online so they could share it with their colleagues and clients, and they just stuck true to their mission and their vision, right? Like they didn't get distracted. Tech trends come and go, but they kept their heads down and kept building all these years. And now they've built a multi-billion-dollar global company. So that's a story that really stands out to me. I think like Airbnb is another good one. I was not an investor in that directly. I had a small piece through a venture fund that I was in, but similar thing, right? Like they pitched 100 investors, and I think 95 or 96 of them said no, and they were selling cereal at one point to help keep the company alive and keep the lights on. So just founders that have that resilience and that long term vision, they have some type of outlook or insight into a market that nobody else has. And then, really, from an investor's perspective, you just have to ask yourself, like, are these the absolute best people in the world to do this? And if they succeed, how big can it get? And then ultimately, just kind of roll the dice and go in on it if you have high conviction, because no one has a crystal ball. I mean, even the Sequoias and the A16Zs of the world, when they're investing at seed stage, no one can really predict who the breakout companies are, who the big winners are going to be. So you still need to have a bit of faith there as well, and just roll the dice and try and help the company wherever you can, and hope for the best in the long run.
Absolutely. You kind of gave hints of the pattern recognition you've developed. You mentioned meeting Dropbox founders or Airbnb founders, and their conviction really sticks out. That's like, it makes them notable because like they not only feel like they know the secret about the market, but they believe in it so much you can feel it. They going back to what we said about sales, they can transfer that enthusiasm really well. But what are some other successful traits you've observed in these founders you've kind of interacted with? What are some things that make them who they are, other than maybe tenacity, resilience, conviction, all the classic answers that we know to be true?
Yeah, I think like an unrelenting focus and discipline, like that's really at the core of it. If we go back to like we were talking about earlier, back to 2021, we saw a lot of companies that were pivoting and going into crypto and NFTs and all this stuff and deviating from their core mission. And a lot of that stuff, a lot of those companies aren't around now, and a lot of that stuff has gone away. So just founders that maybe they're building something now that's cool and sexy and in vogue, but in a year or two from now, when the trends change and it's no longer the cool thing, they continue to build towards that mission because they know they have real customers are solving a real problem. And even though everyone's not talking about it anymore, they see a pathway to building a huge generational company. And fintech is another great example. Like if we go back to 21, 22, everyone was piling money into fintech. Fintech was like the biggest thing, but now no one's really talking about fintech anymore. It's all AI, right? So there's still a lot of really interesting companies though that are staying heads down, focused, disciplined. They're continuing to plug away, capture market share, build great products, and like they're doing incredibly well. Like we have one here in Calgary, for example, Neo Financial, that they're worth several $billions now, last I checked. But similar kind of thing. Like they've just kept their heads down, focus, and discipline for the last 6 years, and they haven't chased what's hot. They haven't chased tech trends. They've just stayed true to their mission and their long term vision.
Hmm. Absolutely. Talk about, you had a portfolio company that closed, crazy sales. There's this crazy sales story about a portfolio company. Love to hear that as well.
Yeah, so again, like coming back to the resilience piece, we have a company in our portfolio, and this story is public. I've heard him tell it, so I can share it. But our portfolio company, Vint, the founder there, Nick King, he was actually in New York pitching a venture capital firm for his seed round a number of years ago, and he's in the middle of his pitch, and the fire alarm in the building goes off. So perfect timing, of course. So everyone gets evacuated. They all go down. They're standing on the sidewalk, and then sure enough, it starts raining. So now they're standing out there in the rain, waiting for the building to open back up. And he just says to himself, he's like, you know what? I'm here to pitch my startup, to get funding. I'm just gonna do it. So he ended up pitching the VCs right there in the rain on the sidewalk. And sure enough, a few days later, they ended up committing into the round. They loved it so much. So just stories like that, like he's kind of like my gauge now, where I ask people when I'm meeting a new founder, I'm like, is this a Nick King? Like, is this person have that type of mentality and resilience? Are they going to do whatever they have to do to make their vision exist in the world? So stuff like that. We had another portfolio company. I won't share the name of this one because it might be a bit financially sensitive, but he actually sold his house and downsized, him and his wife, into a condo so that they could use the proceeds to help seed and bootstrap his business. And he did that for about a year. That was basically his friends, family, and founders around, and got to a handful of customers, started generating revenue, got an MVP out into the market. And then he went on to raise a seed round from a whole group of institutional outside investors. And because he had those data points, he had an MVP, he had customers that we could talk to, he had proven traction, he was growing month over month, and he had skin in the game. The guy literally sold his house and downsized him and his wife into an apartment. So that's a bit of a excess scenario. Like that's a pretty extravagant scenario. I don't recommend people necessarily sell their houses to bootstrap their company, but it's just things like that. And I think you've mentioned it on previous episodes before, like that whole talk about burning the boats and going all in. And it's really important. Like if you want to build a company and you're serious about it, a lot of times that's just the types of stuff that you have to do.
Hmm. Absolutely. Want to ask about two things about your investment thesis I was going through. So you've got this list of things that you look for in startups. Anyone can go to your LinkedIn page or your websites, and they can find this list. But there were a few that really, got my attention. So I'm going to ask you about these three. So the first one was capital efficient. What does that mean, and what does that look like in practice? What does a capital efficient startup look like?
So you probably heard the term like growth at all costs, and that was kind of the mentality back in the Facebook days and the Uber days, where they burned tons of capital and they didn't become profitable for many years. So that's okay. I think that's only good for a very small handful of companies, and there's certain investors that are okay with that. But for me, like, I want to see a company that's capital efficient, and what I mean by that is a company that's not burning obscene amounts of money to generate small amounts of revenue, right? Like, they understand that, okay, we need to sell a product, we need to make money on this product, we have to have margin. Now, it's understandable in the early days that they're probably going to spend more than they make. In fact, as investors, we're expecting that. We're expecting them to burn money for the first 3, 5, 7 years in some instances. But ultimately, at least they're thinking about a path to profitability and they're thinking about capital efficiency. They understand that, raising a subsequent round of funding is not always necessarily going to be an option, right? The venture market could dry up, economic conditions change. So they at least understand that if we need to pull back on our spend and our burn and reach cash flow break even or reach profitability, we have that luxury. And then ultimately, the company can then dictate their own destiny. They can decide whether or not they want to ramp up burn and go for gold and get more customers, or they can dial that back down and just sit and grow more organically at a steadier pace, but not have to worry about running out of cash.
hmm you also talk about meaningful differentiation, which is interesting because meaningful is a little hard to quantify. That's kind of where I want to focus a lot on because with differentiators, everyone has some idea of what their differentiators or 100 of what their differentiators are. But what makes a differentiator meaningful in your eyes, and how do you measure that when you're looking at an investment?
Yeah, I think for me, like the big one, if you just Google the tagline of what the company does and 50 different competitors pop up, it's pretty obvious that they're not that meaningfully differentiated. For me, I want to see a company that's building some kind of unique or novel technology. They're solving a unique problem, or they have some type of unique insight into a market that I'm not aware of or other people aren't aware of. So just something that's different. Like if it's the 10th last mile delivery company, for example, like what is really meaningfully different here, and how can you defend that advantage over time? And I think the one big thing that I see, particularly from first time founders, is they just don't do the necessary research on the competitive landscape, and they don't really know who their competitors are. And like if I'm coming to a first meeting with a founder and I know more about the competitive landscape than they do, that's probably not a great sign. But for me, yeah, it comes down to some type of proprietary advantage or unique technology or unique insight that no one else is exploiting. Or maybe there's one or two other companies that are, but they're also, seed stage or Series A, really early companies, and no one's really captured the bulk of the market yet. It's still up for the taking, and now it's just a matter of who can get there first.
hmm So, like, out of curiosity, we can obviously come up with 100 different companies that had a meaningful differentiation. We talked about like Dropbox as one of them, where they were targeting designers initially, and they had this unique insight, and so they targeted a different niche, different demographic. But out of curiosity, like Lyft, did they have a differentiation, or was it kind of just reputation slash brand that was their meaningful differentiator when you invested?
It was for sure, and that can absolutely be a meaningful differentiation if you have a certain brand advantage or some type of IP assets like that. Whether it's brand, they were paying their drivers better, treating their drivers better, and yeah, that was absolutely their meaningful differentiation. Because in any market, you can position yourself as sort of the good guy or the bad guy, and they were positioning themselves as the good guy, smaller and slower growth, but Uber was under a lot of heat at the time, right? So they had to turn Uber's advantages into disadvantages and exploit those. And because Uber was growing so fast and not adhering to regulations and just going into new markets without actually doing things properly, Lyft had an opportunity there to meaningfully differentiate themselves from Uber and come in a totally different way.
Oh, so okay, so because a lot of founders, and I used to think this as well, it has to be tech. Like you have to be superior in some technical way, but it seems like even just customer support or how you pay your drivers, or even like your culture at your company and how that reflects it onto your brand, all of those can. So, but do you think a lot of investors think that way as well, or are they? How do you communicate that to an investor? Say like, look. I get we don't have some big technical advantage. Like if you're Lyft, how do you pitch that? Like, are you like, look, we're just going to have a better reputation, cleaner brand. We're going to be the ethical company so that consumers like us better. Is that kind of how you pitch it?
I mean, that's absolutely one way. I mean, Zappos is a great example, and Tony Hsieh. Like there was 100 different places to buy shoes, but they meaningfully differentiated through better customer service, better return policies. Like they were able to wedge themselves into a market and generate or become a multi-billion-dollar company. So absolutely, like brand, customer service, and I think nowadays, especially because everything is so digitized, like you have a real unique advantage as a company if you can put customer service first, and you can really serve customers better than anybody else. Because at the end of the day, like for large companies, a lot of times customers are just a number in a ledger, right? It's like you've got your customer number and they don't really care because they don't worry about you. But if you're a small startup, like one of the best things you can do, particularly in the early days, is differentiating yourself from the big guys by going that extra mile, having that extra customer service layer, like going back to the coffee story, like driving out those extra cases of coffee on a Saturday morning because the diner was running low. So you have a real advantage there because I think the personal aspect and the human aspect of business has gotten lost over the past decade or two, just with social media and everything being through our phones and computer screens now. So when you get really good customer service, you notice it and you remember it. Even when you go to a restaurant and you have a really fantastic server or wait staff, like you remember that, right? I was just out for dinner last weekend and we had a phenomenal experience. And the first thing I did when I came home was write a 5-star Google review. And this is a little family run restaurant. And obviously, they're competing with some of the larger restaurant chains, but I'm probably not coming home from the large restaurant chain and writing a 5-star review because they're just not overly focused on customer service. They're just more interested in getting the customer in and out, getting their money on to the next one.
Hmm. Something else you mentioned before we started recording was that a lot of founders that shouldn't be pitching you as an angel investor, venture capitalist, end up pitching you because they don't really realize what kind of person, what kind of founder, what kind of company is supposed to be pitching to fundraise. And so you mentioned that you've got a lot of friends who've got 20-30 million dollar a year businesses, and their kids are in private school, and they've got all the nice amenities, and they could go on nice luxury holidays, but they're fully bootstrapped. Tell me about that a little bit.
Yeah, I think like you've probably heard the stats. Most companies aren't really set up for venture capital. So venture capital is really specifically looking at companies that can get to 100 million in top line revenue and $1 billion or more valuation within 7 to 10 years. So I think as a founder, when you're deciding you want to start a company and what type of company you want to build, there's a lot of consideration there. Like I was out for dinner a couple weeks ago with a friend who, just going back to your story, he built his company, started his company in university. He's been running it for about 15 years now. They do $10 million a year in revenue. Most of that is pure margin. They have a team of 4 people, and he recently built a brand new home. He takes his family on several first class holidays each year, and he has a wonderful lifestyle. Both of his kids are in private school, but again, he's never taken outside money. He's purely bootstrapped it, him and his co founder, and then just reinvested a lot of revenue into growing and expanding the business from there. But understanding what you're getting into when you take outside money from professional investors and venture capitalists, it just totally changes the game because now you're on sort of this rat race milestone track where you have to show growth month over month, quarter over quarter, usually in 18 to 24-month intervals. You have to get to the next level where we can raise another round of funding, the valuation goes up, investors are happy, and you just keep going. And then you go through your series A, your B, your C, your D, and then ideally you get acquired or IPO. In most instances, it's an acquisition, but it's a really different game than building a business by yourself without outside capital and bootstrapping. So I feel like people have romanticized this idea of venture capital, like they're starting a business. Oh, I got to go out and raise venture, and I'm raising around. But the reality is, most companies just don't fit that super high growth profile that venture investors are looking for.
You have to keep raising rounds. How about one and done rounds where you just kind of raise a set amount of capital, whether that's $500,000 or say $2.5 million from an angel syndicate, perhaps? Why, could you technically just do that? Like, raise one done round, grow the company, and then you can reach a liquidity event regardless of how many funding rounds you've done, right?
Yeah, absolutely. I've seen a few companies do that over the years. They raise one small angel round, or maybe they do a friends and family and an angel round, but then the company starts to achieve profitability, and maybe they're growing 5, 10% month over month instead of that typical venture profile of 20 to 30. And they've got a beautiful cash flow generating business. And when a VC is looking at this company, it might be a great company, profitable company, but they're also thinking in the back of their mind, okay, I need an exit within 7 to 10 years, and I need a large enough exit that can return my entire venture fund, ideally, right? Because they have LPs and people that they're beholden to on their back end. So they need to make the fund math work for them, depending on their check size and their fund size. But absolutely, we're seeing that even more now with the development of AI. We're seeing companies get starting to generate 7, 8 figures of revenue. Maybe they've raised, a few 100,000 from some angels in the early days, and they just don't need to raise capital anymore. We even had a company in our portfolio that they became profitable earlier this year. So they had thought that when they raised their seed round that we participated in, they thought they would go on to raise a Series A in maybe 18 to 24 months. But now they're profitable, and now they can decide, well, do we want to go out and try and raise more money or not? So they kind of own their own destiny.
Absolutely. Now, Matt, the last question I want to ask you about is we've talked plenty about the past, but want to talk about a little bit about the future. What excites you as an investor now? What frontiers, what industries or technology are you paying attention to that you're kind of excited by?
Well, obviously, everyone's talking about AI. I think AI is super interesting from a consumer perspective. I've implemented it into my workflows. I use it all the time now. I think Perplexity is fantastic, ChatGPT, a lot of the image generation. But I think from an investment perspective, I've said this before and I'll say it again, but I think 90% of the dollars that are flooding into the AI application layer are likely going to go to zero or consolidate into one of the larger players. And it's a typical tech cycle. Like we've seen this before. We saw it with internet. We saw it with mobile. Like Google was, I think, the 23rd search engine. We see these first generation companies come to market. They flood in to try and capture market share. Meanwhile, the underlying infrastructure is still evolving and developing. We don't even yet know where this AI infrastructure is going to be in a year or two. And OpenAI, for example, just had their second birthday a couple of weeks ago. So like it's still so new and fresh. I don't think we're going to see the true durable long term players emerge for maybe another year or two because right now there's just too many unknowns. So, from an investment perspective, I'm not really spending much time at the AI application layer. But where I'm seeing some really interesting things is companies that maybe 2, 3 years ago didn't really meet that venture scale model. Like they didn't really qualify as a venture scale company. Maybe they were just growing, 50% year over year, 1x year over year. But now they've been able to implement AI into their workflows and completely change the economic profile of their company. For example, we have one company in our portfolio that we invested in that was growing at a steady clip of 2x year over year. And then last year they grew 4x, and this year they're projecting to grow 10x because they've started to implement AI into all their workflows from developers to customer service. So they can do a lot more with a lot less, and they require a lot less resources. So the most interesting part that I'm looking at is like companies that may have not fit the traditional venture capital model a few years ago. I think it's time to take a second look at those companies because there's a lot of founders out there who have found creative ways to improve their growth rates, improve their unit economics, and now maybe they are a venture scale company, right? Like it's worth a second look.
Oh, interesting. So I want to break your answer down to two, but the first one I want to talk about is you mentioned you're implementing AI a lot into your workflow as well. What does that look like for you? What specific apps are you using and how are you using them? How are they helping you?
I would say Perplexity has probably replaced 90% of my Google searches now. Like when it comes down to research, I'll go to Perplexity first and foremost. I really don't use Google that much anymore. In terms of even just for like blog posts and stuff, you can use Copilot, for example, to create images. But those are the big ones. Definitely Perplexity in terms of just asking questions and doing research.
hmm And then you mentioned a lot of non VC scale companies have now become venture scale simply because they can implement AI a lot into their workflows and therefore drastically increase their growth rate. What does that look like? So you mentioned one particular portfolio company that does it. What does that look like in practice? What are they like kind of giving their developers AI copilots, so then they have to hire less developers? What does kind of like those unique implementations look like?
100%. So we're seeing teams that previously you would have to hire maybe a dozen developers. Now you can do the same amount of work with five or six. So they're letting their developers go nuts with the copilots. Like just play around, come up with whatever you can come up with, and figure out creative and unique ways so that we don't have to go out and hire additional developers. And then even from a customer service perspective, we're seeing like one customer support rep can handle so many more tickets now than traditionally having to expand your customer service. Like if you think back to the early days of PayPal, they set up a massive customer service warehouse. I think it was in Colorado somewhere, maybe Denver, and they had hundreds of people just answering phones and emails and dealing with tickets. But now with AI, you can really automate a lot of that overhead away, and you can just have a small core team of people that are overseeing and managing that. So those are the two big ones. I know there's a lot happening in AI when it comes to legal stuff and legal work. So I think that's another area where we're going to see a lot of efficiency improvements in the coming years. But it's changing at such a rapid pace. It seems like every week new products are coming to the market. Existing products are getting better. Like ChatGPT keeps coming out with their new models. Perplexity seems to be getting better on a daily basis. It's absolutely incredible. So it's a wonderful time to be alive as an AI consumer at the application layer. But from an investment perspective, I think, yeah, you got to be really careful about investing into an AI company that's AI first and specifically just focusing on AI when they don't actually own or operate the underlying infrastructure on which they're building.